stage Mr. Tom Bonney.
So today, what we're going to be talking about is what is a buy-sell agreement. That is one of the big things we're going to talk about because it's really important that you guys understand a few of these essential business concepts. Secondly, we're going to go over different buy-sell structures. Then finally, we're going to do a key employee strategy. So is there anybody in the room that has a buy-sell agreement? Raise your hand if you know for sure you've got a buy-sell agreement in place. We got a couple. Okay, I saw a couple of hands. That's very good. Okay, so what is the thing that a buy-sell agreement defines? One of the most important things it defines are triggering events for the sale of your business. And those triggering events are typically death, disability, and retirement. Those are the standard 3 triggering events for a buy-sell agreement. Also, it defines who your buyer is going to be. And finally, it defines a valuation method that will be used at the time of the sale. So this is like something you would probably be working out with your CPA, but it determines like an equity multiple. There's a lot of different ways to value a business. And this would be what the buy-sell agreement defines because you're needing to come up with an exact formula for how your business is going to be valued. So why in the world do you need a buy-sell agreement? One of the big things you need a buy-sell agreement for is to protect your ownership interest in your business. And you also need a buy-sell agreement because it actually improves your credit rating. Now, this is something that most people don't think about at all. But let me ask you this. Do you think a bank would consider a business more creditworthy if they had a plan to continue the business if something happens to the owner? And the answer is yes. It actually helps if you can say to a bank, we have a buy-sell agreement in place and we have a succession plan all nailed down. So this business is not going to implode if something happens to one of the owners. Also, it provides stability for employees. So it's very important that you guys realize if your employees understand that this business is going to continue, even if something happens to one of the owners, that gives them a peace of mind and makes you a more stable employee environment. And finally, it provides an exit plan for your company. So this is super important to have. So what we're going to dig into today is buy-sell structures. So there's 3 primary buy-sell structures that are important to understand. And the first one is entity-owned, and the second one is cross-purchase, and the third one is one-way. So I'm going to do a deep dive into how all 3 of these work so that you can understand what buy-sell structure might be important for you all. However, this is the key what we're going to talk about today. Having a buy-sell agreement is not enough. You have to be able to fund it because having a buy-sell agreement defines the terms of a sale of a business if something happens to one of the owners. But obviously there has to be money there to execute the buy-sell agreement. So funding it is really critical. And what are some optional ways that people fund buy-sell agreements? Well, number 1, you have working capital. That's terrible, right? Because you're not going to want to use all of your business's working capital to fund a buy-sell agreement if something happens to one of the owners. Another thing is loans or lines of credit. Again, if you have a line of credit for your business established, you're not going to want to drain it completely if you need to fund a buy-sell agreement because then you're going to be in debt, and that is not good either. Another thing is savings, and very few businesses honestly are able to put aside enough capital to save to fund a complete buyout for a company. So that is not very traditionally used either. What is the most common thing that people use for buy-sell agreements is life and disability insurance. This is the absolutely most common funding mechanism to provide capital in the event that an owner gets disabled or gets killed somehow or another. So guys, the first one is entity owned. So the business is the owner of this life insurance policy, it's the payer, and it's the beneficiary. So the business does everything. The business is the owner, the payer, and the beneficiary. Now, let's just say that there are 3 partners. And what would happen is the business would buy policies on all of them, and they would own them. So there's the policies going up to the business. Now, if something were to happen to one of these partners, let's just say partner A, something happens to him, so that produces a big windfall of capital to the business, and they use that capital to buy out that partner's estate or their percentage of ownership. So what happens is that money goes to that partner's estate, and now partners B and C move into 50-50 ownership instead of the prior 33% ownership. So their ownership stake increases and the third partner is bought out. Now, there's advantages and disadvantages to doing this entity-owned type of buyout. So the advantage is that obviously it works really, really good when you have a company with a lot of owners. Okay, that is number one. And number two, it's effective for owners with a wide age or health discrepancy. If you really think about it, the cost of doing this is going to be much higher on an older partner than it is on a younger one, just because the cost of funding these things goes up as you get older. And also, if there's a big health discrepancy, the cost is really different between partners, can be as well, depending on their age and health. So when the company is buying all of the policies, that works really, really well. And it creates a business asset, which is huge. Okay, so that is a huge advantage. And the company can access policy cash values for loans if they're funding this with a permanent style life insurance policy, which is the only really good one for this would be whole life. So that would be the kind of policy that you could have that you would build cash in. And some of the disadvantages are the premiums are not tax deductible to the company. And owners B and C in this case, if something happens to A, owners B and C don't get a step up in basis, so that does impact their future capital gains tax. That is the basics of the entity owned. The next one is cross purchase. And cross purchase is even more simple than entity owned. I'm kind of going down in complexity as well. So basically, cross purchase is where there's typically 2 owners, partner A and partner B, and they basically buy policies on each other. Okay, so this is super simple. Partner A has a policy on partner B has a policy on partner A. And basically, if something happens to partner A, that would give partner B a big windfall of capital that he would then use to pay partners A estate off so that he would become the sole owner, right? That is how this would work. It's super simple and it makes total sense for funding your buy-sell agreement like this. Now, this particular structure has some advantages and disadvantages as well. One of the advantages is that the policy owners themselves, rather than the business, can access policy cash value to borrow against for loans. So that is an advantage because the people get to use them themselves. Another advantage would be the owner B in this case. If something happened to owner A, owner B would get a step up in basis to reduce future capital gains tax. So that's a little bit better tax treatment. A disadvantage is that it's complex, meaning that if you have many owners, there's a lot that needs to happen to execute a cross-purchase buy-sell funding. So basically the formula is N times N minus 1. So N is the number of owners. And let's just say this. If you had 6 policy owners, that would be 6 times 6 minus 1 would be 5. That would be 30 policies you would have to do that type of structure. Whereas if it was entity owned, it would just be 6 policies. So it really depends on how many partners you have which way makes the most sense. So cross purchase is definitely best for two owners. And the cash value of the policy owned by owner A is included in the estate. That's another disadvantage. The final thing that is a disadvantage with cross purchase is that younger owners basically have higher policy expenses because they're having to buy and pay for premiums on their older partner, and that can be a huge additional expense to anybody who's in younger and better health. So the final type that I want to go over with you guys, and this is kind of wrapping up the different structures for buy-sell funding, is one way. And this is something that there's not a lot of discussion done on at all, and very few people even know that this particular thing exists. But this is where an owner of a business, let's just say it's one of your residential assisted living businesses, they identify somebody who wants to be the owner in the future. And this is called a one-way buy-sell agreement. And they have an agreement with this future owner. The future owner buys a policy on the owner. Then if something happens to the owner, that cash goes to pay the owner's estate off, and the future owner now becomes the owner of the business. Now, there's a lot of nuance to this, and I'm going to go into quite a bit of detail on this particular one because obviously, you want to make sure it works whether or not the owner lives or dies. So that's why this one is a little bit more complex. So the advantages of this is that it creates a succession plan right off the bat, and the business owner's family does not have to operate the business. So that is super, super important. And they do receive payment as this transition happens. And the employees all stay with the business. The policy cash value can be used to purchase the business at the owner's retirement. And the disadvantage is there needs to be somebody who wants to buy the business. So you have to acquire or find this person who wants to take over for you. And the owner has to be insurable. Okay, so if the owner's not insurable, this is kind of a no-go. And it limits the owner's option for selling to a third party. Once this agreement is in place and this funding mechanism is in place, then the owner can't really change his mind and get out of it, of course, without consent for the person who's on the other end of the agreement. Also, the agreement can restrict some business operations and use of the policy's cash value. But what I would like to do to just make it more clear for you how this would work is show you an example. A 48-year-old business owner, I just picked that age, that has found somebody who wants to buy the business when he retires at age 65 or if he passes away. So the future owner is willing to put in $50,000 a year into a whole life insurance policy on the current owner's life. Okay, so I know that sounds like a lot of money to be putting into this, but this is going to guarantee that the future owner will own that business no matter what. So the policy in this case, the example I did, provides $1.5 million of life insurance. This is how it works. Basically, you have an annual payment of $50,000, and there's the $1.5 million of life insurance. So if you look at this, at year 17, there is $850,000 of cumulative payments put into this policy, and it's producing now $2.2 million of life insurance. So if you take a look here, there's no more money that can go into this or should go into this once the owner is turned 65. And so now it turns on this $100,000 installment payment per year if the owner lives. If the owner dies at any point, then automatically the future owner becomes the owner. So if you take a look at this, just as an example, down here at age 73, there's $800,000 have been paid out already in installments. And let's just say the owner passed away then, there's still over $1 million of life insurance left over to be able to fund the other $700,000. So it absolutely works no matter what in this particular case on this one way. So at the end of 15 years, if the owner lives the whole time, then all $1.5 million has been paid out in installments, and there hasn't been any funding since he turned 65. It just works no matter what. So one of the things that you need to look at adding is funding with a disability insurance. And this is one of the triggers that is defined typically in a buy-sell agreement is if one of the owners gets disabled, okay? And so it's really important that you have this option in there. When a disability occurs, according to the terms of the buy-sell agreement, the disabled owner's interest is purchased. And it can be done in many different ways, right? There's a payout after a waiting period, so it's usually called the elimination period, and it can be however long is predefined in the contract, and then a lump sum would be paid out in the event of a disability to the new owner. And then you can structure it where ongoing payments are done in an installment sale, or you can do it where there's ongoing payments for a period and then a lump sum. But the nice thing about it is that in all three of these, the buy-sell is coordinated with the disability insurance policy. And here's another thing. The agreement uses the insurance company's definition of disability. So I know you guys all understand activities of daily living, right? There's not a person in here that doesn't get that term. So typically disability triggers are based on not being able to perform 2 of the 6 activities of daily living. That's usually the trigger. But it really is helpful if you just use the disability insurance company's definition of disability, so there's not an argument about whether the owner is truly disabled or not. And finally, premiums are not tax deductible on this, but the benefits are income tax free. So the other thing I wanted to talk to you about, this is protecting you as a business owner if you have a rock star key employee. What is your greatest business asset, guys? Most people would agree it's your employees. You guys all have employees that work with you, registered nurses, housing managers, admin. I don't know who would be that one person that you just can't live without, but if there is a person in your business that you can't live without, you can do what's called a key employee policy on them. All right. And there's just a few rules you have to know about whether or not this would work for you. And one of the rules is who in the heck qualifies for this, right? So the income they make is way more important than whatever you call them, okay? So the key is that they have to have at least $100,000 of annual compensation, and that is their salary plus bonuses over a 2-year average. That's what determines whether or not they qualify as a key employee. The other thing is they need to have a unique role. It can't be one of 10 people who do the same thing, right? It has to be somebody who's in a unique position for them to qualify as a key employee for you to be able to do this particular key employee strategy on. And finally, this is really cool, is that you have a coverage maximum on them of 15 times their compensation. This is where you, as the business owner, are putting a policy on your key employee so that if something happens to them, you are now covered and have, a couple of years at least, or multiple years of income coming in and a windfall to be able to replace that key employee. If you were paying somebody $100,000, they would qualify for a $1.5 million policy. So what is the best solution to use for this? Okay, there's all kinds of different options, but one is term insurance, and it totally works. It's lower initial annual cost, and it has a future conversion option if you do it right, and it can meet a short-term need, okay? So this is good for getting into it in a short-term way. Then there's a tax-free death benefit, obviously, that comes to you. And then you could also do a specially designed whole life policy that is really awesome because it turns into an asset for your business. And that has tax-favored accumulation inside of it, and the cash value is protected from creditors and predators. As the owner of this, on your key employee, you would have unrestricted access to policy loans, and you basically have a line of credit set up that is internal that would be allowing you to use it as an opportunity fund or an emergency fund. and the credit line never expires. So what I thought I would do is I thought I would show you guys an example of what this would look like, just to get your wheels spinning on whether or not you think this might be a good option for you to do. So let's just take a look at a sample and key employee making $100,000 who's 40 years old. So the end of year one, he would be 41, and you would have basically an annual minimum of just over $14,000 on this $1.5 million policy. You would have added funding of $21,000 for a total of about $36,000. And that would create an immediate line of credit that you could borrow against of about $21,000. So $1.5 million of life insurance. So one of the things that happens when you do this right is that you start building this cash inside of these policies. Again, this is now on your key employee, and starting the fourth year, a cash-on-cash return is net positive. So you can see you're putting in $36,000 and it's growing by more than $36,000 in the fourth year, which is really cool. And then it usually has full capitalization by around year 8. So in this case, the total funding was about $288,000, and you have more than that available inside of that particular policy by the time you get to the 8th year. That's just average the way they work. Of course, all this varies, completely based on what you're exactly doing and how old the person is and what their health is. But this is just a great option for looking at doing this key employee type savings and protection strategy for you guys as business owners. Some of the most common questions I get, I thought I would try to just hit them real quick. And that is, I have a buy-sell agreement and it's funded. Is there anything else? So you guys might think that you have a buy-sell agreement, you have this life insurance policy, and that's all you need to do. But in fact, a huge court case was just ruled on recently where in these agreements, they typically need to be reviewed annually and make sure that the valuation methods are correct, and they need to make sure that the policy has the correct values in it. And honestly, what happened is one of them just got completely thrown out because they didn't do their annual review. So I have a buy-sell agreement. It's funded. Anything else? Yes, you need to maintain it. Okay, so that's super important. Another question I get is, I haven't done any planning on this. I have no idea what you're even talking about. How do I get started on this? Well, one of the things that would be good to do would be to get connected. I could talk to your attorney if you have one. If not, I could work to try to find one for you guys. But it's basically an attorney and a CPA need to be involved in the valuation methodology and in the contract. And then I come in and help with the funding. This is the final question. I have a buy-sell agreement. Can you help with funding? That's what I do. I look at your buy-sell agreement, look at your valuation methodology, look at your complete financial picture, and try to figure out what is the best solution for you. Is it going to be a one-way? Is it going to be a cross-purchase? Is it going to be an entity purchase? How is it going to be term? Is it going to be permanent? What is the best way to fund it to where it gives you the most bang for your buck and gives you the ability to really protect yourself as business owners? If you just want to be like 90% of the businesses out there, they don't have a buy-sell agreement. And if they do have a buy-sell agreement, it's not funded, it's not properly looked after. So I would really encourage you guys to look at this. And if you need some help, please reach out. So thank you guys very much. I really appreciate your time. I really appreciate you listening.